In a world of bubbling asset valuations, where should investors turn to? Joining us today on the sidelines of the Precious Metals Summit here in beautiful Beaver Creek is Sam Pelaez. He's the CIO of Galileo Global Equity Advisors. Sam, welcome back to the show. Last time we saw each other was in Iceland.
That's right.
It's a little warmer here in Colorado, but
we only seem to meet in beautiful
right?
places.
I'm not going to complain about that. So tell us how you see your strategy right now, as an investor and, as a leader in a fund. Are you more aggressive or defensive in this environment?
Right now, I would say it's a combination. It's a difficult question to answer that way. We're aggressive in terms that we're buying positions and investing in sectors of the economy that are not actually being very loved right now. We like being on that other side of the trade, contrarian, deep value opportunities. So in that sense, I think we are being very aggressive. Conversely, within that bucket, we're only buying quality. We know what are the good quality companies. We're looking at mining and energy very seriously right now. We know what quality is in those spaces, so we're looking to buy more of those companies.
Well, Sam, you're the Chief Investment Officer for Galileo. Tell us a little bit about the fund.
So we have three funds at Galileo. One is a mid-cap income fund. The second one is a growth fund. The third one is a technology fund. It's completely separate. It's high net worth investors. But for the two mutual funds that we have, we like to have very concentrated positions. Not so much in one equity, but perhaps in sectors, certain sectors of the economy. On the growth fund right now, we're overweight materials and we're overweight energy. I've actually been looking at this study where if you look at the TSX small cap in Canada, it's about 50% materials and energy. When you look at the slate of mutual funds out there that track the small cap universe, virtually all of them are underweight the two sectors, both, each simultaneously, to the tune of about 50%. So they only have about 25% exposure to a sector where the benchmark is 50%. And at this time of depressed valuations, when the sector has underperformed all of their sectors, I think it's a great time to be aggressive and to get more involved in those two sectors.
So in terms of gold now, right, and precious metals, what kind of a role does it play for you right now?
Our positioning, we always advocate for investors to have a certain amount of exposure to gold outside of our mutual fund, and then through our mutual fund or outside our mutual fund have exposure to gold equities. Gold equities are a phenomenal diversifier to any portfolio over 1, 3, 5, 10, 30-year periods. And we like science and we like models, and that's where our models tell us.
But a lot of investors would say, but look at this environment right now. I'm not making money in the mining stocks. Gold's not really moving much. So what do you say as a response to that?
I'd say a number of things. Number one, I think Q4 is going to be very good for gold. We have a very critical catalyst next week with the Fed decision on hiking rates and the hiking cycle. And just to put an intermission there, there's this chart that was published last week by Jeff Gundlach that I really, really like, because we've all heard about the Taylor rule, and the Taylor was one of the potential candidates to be at the Fed. And the Taylor rule says rates right now should be at 5%. So we're significantly behind the curve. And what that means is real rates are actually still negative. Even though rates have, we've been in this rate hiking cycle, real rates are still negative. And when real rates are negative, it's positive for gold.
Right. And the fact, this hike is pretty much priced in already. But you're saying even if there are further hikes, it's not enough that would cause gold prices to be suppressed.
Correct. And what I'm trying to suggest is we would need to accelerate the pace of the rate hiking cycle to get to the Taylor rule. I don't see an environment in the U.S. with the trade war headlines. If you look at some of the deep sectors of the economy, don't look at the S&P 500 because that's near all-time highs.
Right.
But if you look at construction materials, big drop year to date. Junk bonds, big drop year to date. So some elements of the core of the economy are actually underperforming. So I don't think.
So do you think the U.S. economy is healthy then, or the data that we're seeing is painting a picture that it's so robust? Do you believe it?
Well, the last GDP we had was Q2, and that was phenomenal. But obviously we had the tailwind of the tax. The lowering of the corporate tax rates, that was a one-time event. I mean, it was probably going to last a few quarters, but we're not going to see that next year. All of that is going to be consolidated into this year. So I think there's been one-off situations that have helped the U.S. economy look more healthy this year than it actually is. And I always go back to construction materials. It's so core to the U.S. economy. It's so core to jobs. Housing data is not very good. I'm not saying the U.S. is going into a recession. I'm just saying there's perhaps a false optimism about the strength of the economy and how many new rate hikes can it absorb. I don't think it can absorb rate hikes to 5% where the Taylor rule is right now, which is a level in which real rates would be positive. So if we can't get there based on this, weaknesses in certain specific sectors, then the real rates will remain negative. And that should be positive for gold, should be positive for all commodities. Conversely, it should be negative for the US dollar.
Sam, thank you so much for your thoughts. Always a pleasure.
Thank you.
And thank you for watching. We'll have much more for you. We're just starting our coverage here in beautiful Beaver Creek, so be sure to stay tuned to Kitco.com.